Hello, everyone, and welcome to Financial Accounting. Today, we will continue studying the accounting cycle, capturing economic events, and we'll look at several examples. Before we move to the examples, let's quickly review the use of accounts, the accounting equation, the rules of debits and credits, and double entry accounting. If you are interested in learning more about this topic, please watch the video, The Accounting Cycle, Capturing Economic Events. I am posting the link right here and in the description to this video. To review, the ledger is a group of accounts for a particular business. An account is an individual record showing increases and decreases in the balance, like in your checkbook. Accountants often use a T account to represent a general ledger account. The left side of the T account is always called a debit side, and the right side is always called the credit side. As we learned in the previous video, this terminology comes from the time when the double entry system was first developed. These terms are still used as a matter of convention. Here are the dates and amounts of transactions that impacted the cash account of our sample company. Because cash is an asset and assets are increased by debit and decreased by credit, all receipts or increases should be placed on the debit or left side of the ledger account. As we already learned, liabilities and equity have the opposite sign of assets, as they are on the opposite side of the equation. If liabilities were to move to the left side of the equation, it would read assets minus liabilities equal owner's equity. As a convention of double entry accounting, it's been decided that the debit or left side of an asset account will represent an asset in the asset account balance. This convention determines all of the remaining math. Because liabilities and equity have the opposite sign of assets, a debit to a liability or equity account must mean a decrease, and credit means an increase. Accountants use the double entry accounting system. This means that all transactions will have an equal dollar amount of debits and credits. How is it going so far? If you like this video, give it a thumbs up so I know what you think. And if you have any questions, feel free to post them in the comments to this video. Let's briefly review the rules of debit and credit. As we already learned, assets are increased by debit and decreased by credit, while liabilities and owner's equity are increased by credit and decreased by debit. Now, let's revisit many of the transactions of Family Healthcare Company that we already discussed in the video Integrated Financial Statements Framework. In that video, we learned how transactions were recorded in terms of the accounting equation and Integrated Financial Statements Framework. If you haven't had a chance to watch the video, I'm posted the link right here, as well as in the description box. Now let's add a bit more fun to it and learn how to apply the rules of debit and credit and how to record those transactions in T accounts. Let's place the amount of each transaction in the proper ledger account. Try to determine how the amounts will be posted before moving on to see the answer. In the first transaction, Dr. Landry deposited $6,000 in a bank account in the name of his company, Family Healthcare, in return for shares of stock in the corporation. Cash is an asset account, and the capital stock is an owner's equity account. Did the cash account increase or decrease? How about the capital stock account? Did it increase or decrease? If we plug the numbers in the accounting equation, we have $6,000 equals 0 plus $6,000. Note that liabilities are not affected by this transaction. Cash is an asset account and is increased by debit. Capital stock is an owner's equity account and is increased by credit. Since Dr. Landry invested $6,000 in the company's cash account increased. The cash account increased, so $6,000 was placed on the left or debit side of the ledger account. Remember, a debit to an asset account means an increase. The capital stock account was increased or credited for $6,000. Remember, a credit to an equity account represents an increase in the account. This results in an equal debit and credit impact in the transaction, so we have followed the rules of double entry accounting. And a little secret here. If you are unsure whether the capital stock account should be debited or credited, remember that debits are always equal to credits. If we debited cash account for $6,000, it means that we have to credit the capital stock account also for $6,000. In the next transaction, Family Healthcare borrows $10,000 from First National Bank to finance its operations. Will the cash account increase or decrease? Will notes payable, a liability account, increase or decrease? This decision must be made before we can determine which side of the ledger account will be used to record the amount involved. Let's first plug the numbers in the accounting equation. Since the company now has more cash and more liabilities, the accounting equation is 10,000 equals 10,000 plus 0. This transaction did not affect owner's equity. The cash account will increase by 10,000. An increase in an asset account is shown with a debit. This amount is put on the debit or left side of the ledger account. The liability account, called notes payable, also increased. An increase is shown in a liability account with a credit. The 10,000 is put on the credit or right side of the ledger account. Note that debit is equal to credit. In the next transaction, Family Healthcare buys land for $12,000 cash. Will the land account increase or decrease? How about the cash account? Will it increase or decrease? Because we paid cash, it decreased, and because we got land, the land account increased. But since both accounts are asset accounts, total assets did not change. The accounting equation looks as follows. 12,000 minus 12,000 equals to 0 plus 0. We have zeros on the right side of the equation, as this transaction did not affect liabilities and owner's equity accounts. The land account is an asset. An increase in an asset account is shown with a debit. The cost of the land, 12,000, is placed on the debit or left side of the ledger account. The cash account will decrease by 12,000. A decrease in an asset account is shown with a credit. The payment is placed on the credit or right side of the cash ledger account. Let's also take a closer look at the owner's or shareholders or stockholders' equity. By the way, I have a good video discussing owners versus shareholders or stockholders. If you are interested, follow the link that I'm posting here or click on the link posted in the description to this video. Capital stock is an investment. It increases owners or stockholders' equity. Therefore, it is increased by credit and decreased by debit. Dividends, revenues, and expenses are a part of retained earnings, which is a part of stockholders' equity. Dividends and expenses decrease retained earnings and shareholders' equity, and therefore have the opposite rules. They are increased by debit and decreased by credit. Revenues increase retained earnings and stockholders' equity. Revenue is increased by credit and decreased by debit. On January 31st, Family Health Care earned patient fees of $5,500, receiving the fees in cash. Will revenue account increase or decrease? Will cash account increase or decrease? Remember to determine the nature of the account involved when deciding increases or decreases. This decision will help place the amount on the correct side of the ledger account involved. Since cash is received and revenues are earned, the accounting equation looks as follows. 5,500 equals 0 plus 5,500. This transaction did not affect liabilities. Cash, an asset account, increased by 5,500. Increases in asset accounts are shown as debits. So the amount involved is placed on the debit or left side of cash ledger account. The revenue account, called fees earned, increased. Increases in revenue account are shown on the credit or right side of the ledger account. So $5,500 is placed on the credit side of the revenue account. Since revenue is a part of retained earnings, we use the retained earnings account here for simplicity. On January 31st, Family Health Care paid expenses as follows. Wages, $1,125. Rent, $950. Utilities, $450. Interest, $100. And miscellaneous, $275. Will cash account increase or decrease? Will retained earnings account increase or decrease? The company paid for expenses, which means that cash decreased and the retained earnings account is decreased as expenses decrease retained earnings. The cash account decreased by $2,900. Decreases in asset account are shown with a credit. So the amount is placed on the credit or right side of the cash account. The expense accounts increased by $2,900. Increases in expense accounts are shown as debits. So the amount is placed on the debit or left side of the expense accounts. For simplicity, we use one ledger account called retained earnings, as expenses are a part of retained earnings. Because expenses decrease retained earnings, they are shown on the left side of the retained earnings T account. In the real world, you will have a separate ledger account for major categories of expenses. If you would like to learn how to close expense accounts to retained earnings, I would recommend watching the video, The Accounting Cycle, Reporting Financial Results. I am posting the link in the description to this video. Our last transaction is to pay 1,500 dividends. Will cash account increase or decrease? Will retained earnings account increase or decrease? The company paid dividends, which means that cash decreased and retained earnings decreased as well, as dividends decreased retained earnings. The cash account decreased by 1,500. Decreases in asset accounts are shown with a credit. So the amount is placed on the credit or right side of the cash account. The dividends account increased by $1,500. Increases in dividends account are shown as debits. So the amount is placed on the debit or left side of the dividends account. Again, we use one ledger account called retained earnings for simplicity, as dividends are part of retained earnings. Because dividends decrease retained earnings, they are shown on the left side of the retained earnings T account. In the real world, you will have a separate ledger account for dividends. Remember to watch the video, The Accounting Cycle, Reporting Financial Results, if you would like to learn how to close temporary accounts to retained earnings. The link is posted in the description to this video. Now, let's look at all transactions and how it all comes together. We had multiple transactions that involved cash. We had more receipts than disbursements. As a result, the balance in the cash account is $5,100, and the balance is shown on the debit side of the cash T account. The balance in the land account is $12,000, and it is on the left or debit side. We only had one transaction, and it was an increase in land, so we know the balance should be on the debit side, as land is an asset and assets are increased by debit. The balance in the note payable is $10,000. It is shown on the right or credit side because note payable is a liability account and liabilities are increased by credit. The balance in the capital stock account is $6,000, and it is shown on the right or credit side as capital stock is an owner's equity account and it is increased by credit. The balance in the retained earnings account is $1,100. We have multiple transactions that involve retained earnings. Because revenues exceeded expenses and dividends, the balance is shown on the right or credit side. Retained earnings is an owner's equity account and is increased by credit. Note that the balance in cash account is the same in the balance sheet section, the statements of cash flows section, and in the cash ledger or T account. Let's also take a quick look at the income statement. Net income is the amount by which revenues exceed expenses. In our case, net income is $2,600, which is the difference between $5,500 revenue and $2,900 expenses. You can see revenue and expenses in the retained earnings section and the retained earnings ledger or T account. Now that we have all transactions in ledger accounts, let's get back and review the accounting equation. Note that all assets balances are on the left or debit side of the T accounts, and all liabilities and owner's equities balances are on the right or credit side of the T accounts. Total assets are $5,100 cash plus $12,000 land equals to $17,100. Total liabilities plus owner's equity is equal to $10,000 note payable plus $6,000 capital stock plus $1,100 retained earnings equal to $17,100. Our accounting equation balances. Thank you for watching this video, and I hope you found it helpful. Don't forget to like, subscribe, and forward it to anyone who might be interested in learning accounting. I will see you soon.